them differently. The first is that this is an abnormally, this year has seen an abnormally high level of correlation between the US markets and the Indian markets. So on more than 70% of the days, the direction in which the S&P 500 closed last night has driven the direction in which the Nifty closes today. This is 70%. See, if you were doing random stuff, it will be 50. On an average, if you do the time series, it's about 60, 65, given that there is a high level of foreign ownership in India. There is positive correlation, which is observable. But this year, it's the highest in 30 years. In fact, every day, the most important thing that I see when in terms of the direction the market is going to take, it is because what the Fed is doing, what the developed market central banks are doing, is absolutely disrupting asset pricing in their attempts, their fear of deflation, their attempt to somehow maintain some semblance of inflation. They're going overboard, I think, in just money printing and supporting the financial markets. In fact, who would have thought that the issue of investment grade bonds in the US has been like 90% higher than the same time last year. So when all of these things are happening, it is very unwise to just look at domestic economic indicators when we are thinking about the market. So if there is going to be a phase of de-risking in global markets, because now what has also happened is that the number of defaults has started going up, right? So in the first stage, there was market dysfunction. Then the Fed just printed like there was no tomorrow. Balance sheet went up by 10% of GDP. And then the market started functioning, and we saw all these IG, the investment grade bond issuances in the US. Now we are seeing the defaults come through. So in the high yield space, that is a junk bond space, the defaults are now starting to come through. And that will have an impact on sentiment, on the asset pricing, because all the Fed did was make the market function. So as that de-risking starts, I don't think our markets will be immune. Coming to the earnings themselves, we call them the fast, the slow, and the lag, meaning that the easy, the difficult, and the lag. Basically, when you're forecasting in an environment like this, I mean, if you're an autos analyst, how do you forecast next year's auto demand? The FY22 auto demand, right? It's very hard. You don't even know how long the lockdown is going to last. But if you're an oil analyst, if you're a steel analyst, if you're an aluminum analyst, I mean, I've been that one for 15 years, so I know it's not easy. But at least you have some tradable thing that is giving you price signals. And you can base on that. So what we have seen is that India's earnings estimates have fallen among the least among all emerging markets, despite having a very harsh lockdown. So I think there is significantly more earnings cuts that are likely. We are still at 20% plus for FY21. Is that likely? I don't think so. The lagged earnings will be for the financial system, where there is a lot of regulatory forbearance that is likely to come through. That's the only way to preserve some sanity there. That may help stuff, but that means lower price to books, right? So if you have no clarity on what the real underlying earnings are, you'll give a lower multiple. So I think from a market perspective, these are going to be the two primary drivers. I expect significantly higher earnings downgrades in the next 3 to 6 months. I don't see the lockdowns lifting fully. I think we may get to 85-90% of the economy for say in the next 3-4 months. But getting to 100% will take, I think, a very, very long time, at least in market time sense. And therefore, I would be very cautious when we are looking at Nifty levels right now.
Neelkanth, good morning. Yes, very important points that you make out there. And I actually want to extrapolate the point on defaults with the Indian context, the Indian system, because we've seen lots of measures, whether it's the moratorium, whether it's more liquidity being offered by the RBI, or now the sovereign willing to back credit that's going to go to NBFCs, for instance. Do these measures create adequate buffers? Have they created adequate protection to protect against a big wave of NPAs, COVID-related NPAs, or are we looking at perhaps a serious financial issue as well in the coming months?
Right. So let me take a few minutes. I tend to get into long monologues, but this one is essential. there is a loss, right? So if you shut down the economy now, depending on whose estimates you take, suppose there was 6% real GDP growth consensus. Now we are at whatever -2, -4, take anyone's pick. So that is the income lost for this year, right? Now, not all of this income lost needs to be compensated. There is a framework that you can apply that 2/3 of this income, the GDP in India, is personal income. A lot of that is lower consumption. I mean, as you're sitting at home, I'm sitting at home, our consumption levels have dropped. That is dropped for everyone. Showrooms are now starting to open up. For 1 month, there was 0 sales in cars. When you think about the government and government intervention, government is just a collective of all of us, right? All of us taxpayers give the money to the government and then it decides. So why should we give money to the government to distribute to among people who already don't need it, right? Or who are going to be contributing the money as well. So, so long as there are people who are dipping into their savings to the basic consumption or are dropping into their consumption itself, there's no intervention needed. What is needed is to replenish the risk capital lost by the corporates, because the government also loses taxes, but the government is a sovereign, right? They can decide to have a higher fiscal deficit and somehow print money if needed. We can discuss that in later issues. There are questions, but as of now, the bigger question is what happens to the losses to the corporates? Because the losses or the income loss for people who have no savings and no income, I mean, I think has to be dealt with by migrant labor camps, delivering food, delivering basic income. More of that can happen, should happen maybe. But from corporate side, suppose there is, for argument's sake, and this is just a number I'm using as an example, this is not my estimate or forecast, say there is a 2 lakh crore loss. How does it get absorbed? So it will get absorbed in terms of the risk capital, the equity base of the company shrinking. And if that is not sufficient, they'll start defaulting on loans. So this 2 lakh crores has to be absorbed by someone, right? Now, who is that someone? If it goes through the banking system, eventually it is possible that the government may have to recapitalize the banks. So that capital will have to come through the banks. If these firms deplete their risk capital and are therefore unable to grow, that means slower taxes in the future. So that's also the government's loss. So the question is, should the losses be borne upfront, or should the losses percolate through the chain, through the system, to the corporates, then to the banks, and then again the government comes in and replenishes? And say 2 years later, when we are like completely out of it, the government, we are discussing how the government can stimulate activity because there is no risk appetite or risk capital. So it is much better to absorb losses upfront. So some of the measures that we are seeing, in my view, allow for the losses to be absorbed upfront. So some people have said that this 3 lakh crore MSME scheme will just be used for evergreening loans. I think, well, that's not stated, but I wouldn't be surprised if that was the objective.